Welcome to July's monthly market report. We are moving into the second half of the year and taking stock of how the market has fared so far. The good news is that despite the many gloomy forecasts from early January, residential real estate markets have returned to a more typical seasonal trends as buyer demand has improved. While changes remain for today's buyers and would-be sellers, there's hope and growth in the data. As we delve into the numbers, it is an important reminder to what a challenging last 3 years we have lived through, both on the personal health and economic front and also from the standpoint of the real estate market we lived through. It was an unprecedented period, one fraught with a lot of uncertainty, a lot of challenges, and now in the wake of the real estate market that was by any stretch anything but average. Some were calling it the unicorn years. It's important to also remember that coming around to the new normal, for many participants in the market, there's lingering uncertainty, concern, and perhaps sometimes confusion, especially as, the headlines, they spent a better part of this last year calling for a housing recession, for an economic downturn, even a decline in prices. I think they were saying pretty severe. Here is the top good news. Number one, housing is normalizing after 2 unprecedented unicorn years. We're seeing that normalization show up in demand. We're also seeing that normalization show up in prices. It's also showing up as a return of seasonality. We're seeing the same trends as they have in the past. It picks up in the spring, build up towards the summer, and a slowdown during, I'd say, the late fall and winter months. Typically, I'd say it starts around the holiday season is where the slowdown happens, at least here in Colorado. It varies around the country, of course. In tandem with that, and importantly, we're also seeing prices rebounding in homes under $550,000. By and large, we're seeing a market moving toward a new normal. However, there's a reality check to some of the good news. Number one, supply has been constrained. As a result, homeowners have limited option when it comes to trade up, trade down, moving to their next home, in part because of this tight supply, as well as, higher mortgage rate. Not surprisingly, the number of new listings coming to market from a lot of these homeowners who might be ready to move, otherwise are still declining as we pass the mid-year. And as a result, because of that, we're seeing prices beginning to rise again, especially on homes priced less than $550,000, which really puts affordability as a primary challenge for many people wanting to participate in this year's market. There is a silver lining to that reality check. That's part of the outlook. Well, we're seeing some good news. New construction is growing, which is offering more options for buyers and sellers. And we'll take a closer look at that, basically what that means. And in turn, we can expect a moderately active summer season. Here we start with the demand side, and we've seen buyer demand. It returns to market after about 6 or 7 months in 2022, in which rising mortgage rates scared off a lot of folks from the market and they pulled back. In May of this year, Freddie Mac conducted a survey of buyers and sellers and found that 18% of Americans said they are likely to buy a home in the next 6 months. That number is significant in any given year, and I'm talking pre-pandemic. The normal share of people buying a home runs somewhere in the neighborhood of 8% to 10%. We are well north of that based on that forecast. A clear indication that for a lot of Americans today, the desire to buy a home is very much on the front burner. It's in part because of life changes, circumstantial changes, and in many respects the desire to move on from a very challenging pandemic period. At the same time, 16% of Americans who own their homes said they are likely to sell in the next 6 months. Well, these are really solid indicators of a market that's returning to a more normal or typical seasonal trend, returning towards a more active market. On the demand side, it's also important to remember that today's buyers come to market in a much stronger financial shape. We now have 10 months of mortgage rates moving in a well-confined range around 6 or 7%. This started back in October. Well, yes, we crested that 7% threshold a few times, but by and large, we've been confined in this range, which for all intents and purposes become, in a sense, the new normal. Years back, we were kind of used to even higher rates than that. New normal, well, for now. What we're able to pick up from the buyer side is that many buyers across the country, well, they've accepted this, even though it's much harder than it was just a year ago. They have accepted this as the new normal. So instead of asking, can I afford to buy a house? Some of them are really asking, how can I make the numbers work so I can purchase a home? Again, another sign of normalizing markets. Relatively steady rates have led to several consecutive months of consistent home sales. Let's take a look at the numbers. What you see here are existing home sales from 2014 onward until this year. The green bars represent the months of this year. And as of May, the latest number, we were running at a 4.3 million annualized pace of sales with a nice steady month-over-month increase. Yes, we're below the long-term average of 5.3 million or so, but at the same time, as I mentioned earlier, despite the really gloomy predictions of a massive decline in sales and prices this year, what we're seeing is a much steadier market, which is chugging right along as many Americans are looking for their first or next home. The bulk of sales nationally are taking place in that mid-range of the market, let's say 250 to 500,000 nationally, which is really the more affordable part of the market. While available inventory strongly impacts home sales, existing home sales activities are down sizably due to the current supply being roughly half the level of 2019. When you look at the average month supply for the 2011 to 2019 period, you see it's roughly about 5 months. That's the level of inventory you'd be expecting in a balanced market. And as of May of this year, we are at a 3-month supply, an improvement indeed from the unicorn years of the pandemic period. It's still quite a bit short of a balanced market. With the picture of demand showing a rebound and improvement, let's take a quick look on the supply of existing home. What we're seeing here is supply is improving, but still remains limited. According to Realtor.com, there were 7.1% more homes for sale in June compared to the same time in 2022, which translates into 41,000 more homes available to buy on a typical day during the month compared to a year ago. Realtor.com also highlights that the inventory growth rate for homes continue to slow for the 4th month in a row. So taking a picture of what that looks like, you see active listings with 2023 highlighted in green. You see those are much higher than the same period in 2021 and 2022. Well, that's really good news. Buyers today have more options, and importantly, those homes that are coming and staying on the market are listed longer, which gives a lot of buyers extra time to make their decisions to prepare their offers. All in all, really good development for markets. Keep in mind that we're still below the levels we were in 2017 through 2019. This, in a sense, captures how tight the market for new listings is and how significantly uncertain many homeowners feel about today's market. Well, there's a silver lining to this. Mark Fleming, the chief economist of First American, highlights that history has shown that higher rates may take the steam out of rising prices, but it doesn't cause them to collapse entirely. This is especially true in today's housing market, where demand for homes can continue to outpace supply, and that keeps pressure on the house prices. Why is that relevant? As we take a look at home prices, we're seeing a rebound, which reflects, to Mark's point, of an ongoing market dynamic that confounds a lot of the headlines from last fall that called for a major correction and huge declines in prices. In looking at Realtor.com's listing prices, you see a ramp up in 2022 when prices reached their peak in June of the year. And then as the interest rates went from 5.5% in June to over 7% in October and November, there's a retreat in listing prices naturally for a lot of buyers and homeowners who would have sold. That signaled a major shift in the market, with both homeowners and buyers pulling back. However, as 2023 came around, what we saw was a lot of buyers come to terms with the fact that higher rates, well, they seem to be here to stay. And they live in circumstances requiring them to ask themselves, should I continue renting? Should I buy? And so many returned to the market, also creating an increase in demand. We saw prices stabilizing and then begin an upward push as we move towards the midpoint of the year. That seasonal component begins to make a very clear return. In looking at list prices going all the way back to January 2017, you'll see prices tend to rise during the spring and summer months. Prices peak during the summer and then retreat in the late fall and winter. Well, this repeats as it has for many years. To me, it's been a trend I've talked about before. In 2022, prices rose sharply towards a June peak of, this is nationally, 449,000. Then they retreated equally sharply over the fall and winter months, only then to rebound. As of June of this year, median prices were less than 1% below, 0.09 to be precise, what they were during last year's record high level. That's a clear indication that market dynamics are shifting towards a relatively normal seasonal pattern. Buyers are active in markets as housing is normalizing. It speaks to a return towards health in the market. Prices are rebounding. This should offer a lot of confidence to homeowners who have been reluctant to move forward out of fear that they may have missed last year's peak and may not be able to realize a solid equity position. Keep in mind that's a national view. To summarize what's going on here in Colorado, we still have a fairly low inventory of homes. Homes priced at $550,000 or less, they've been in high demand, and their prices have been rising steadily since the beginning of the year. The low was in December. Many builders are optimistic about long-term demand, however, and are continuing to build. They've been doing price reductions, and a lot of builders are offering incentives, including rate buy-downs, among other things. Some builders even offer agents an above-average commission, well, to get us to bring you in. Well, this appears to be working because newly built homes are outselling existing homes. That's an unusual trend. Another segment of the market, higher priced homes that are above $650,000, and especially if you get into the $1 million plus range, that's a different story. They are experiencing longer market times and significant price reductions. My recent observations found many homes with $100,000 to even $200,000 reductions. My insight tells me this pattern's going to continue for a while, probably through the summer. And aside from any seasonal changes, once the rates start dropping, especially when we get down closer to 5% again, a major shift will occur. Inventory and demand will rise, as will prices. There's going to be a sweet spot for buyers at just before the rates drop, before the prices start going up again, where they save on the sales price, but they're going to be paying a higher payment for a short while, and then they can refinance to a lower rate. Thank you. If you have any questions, I'm happy to take your call, or you can email, text. Take care.